Imagine donating to a charity, feeling good about helping others, and then realizing you just saved hundreds or even thousands of dollars on your taxes. Sounds amazing, right? But here's the catch. Most people have no idea how to actually make their charitable donations work in their favor. They give, they feel good, but they miss out on huge tax savings. So today, I'm going to show you exactly how to maximize your charity tax benefits, step by step, so you can give smarter, not just give more. Number 1. Why charitable giving can be a win-win situation. Let's start with the basics. When you donate to a qualified charity, you can claim that donation as a deduction on your taxes. This means your taxable income goes down, and you pay less to the IRS. Here's an example. Let's say you earn $60,000 a year. You decide to donate $3,000 to a qualified charity. If you itemize your deductions, your taxable income now becomes $57,000. You just reduce the amount you owe taxes on. But the win goes beyond the numbers. You're helping a cause you care about, feeding families, protecting animals, funding education, and also keeping more money in your own pocket legally. That's what I call smart generosity. Number 2. Understand what qualified charities mean. Here's where many beginners slip up. Not every charity is IRS approved for tax deductions. If you donate to your friend's GoFundMe or a random online campaign, it might make you feel good, but it won't give you any tax benefit. The IRS only recognizes donations made to registered 501(c)(3) organizations. These include most big names like the Red Cross, Salvation Army, and Habitat for Humanity. But smaller local nonprofits can qualify too. To be sure, you can check the IRS's online tax-exempt organization search tool before donating. Here's a tip. If the organization says your donation is tax-deductible, it's a good sign, but always double-check. Scammers often mimic real charities to trick kind-hearted people. Number 3. Know what you can and can't deduct. Now let's clear up a common misunderstanding. You can't deduct every act of kindness. For example, if you buy raffle tickets at a charity event, only the portion that's above the fair market value is deductible. The same goes for charity dinners. If you pay $100 for a meal that's worth $40, only $60 counts as a deduction. Also, time and effort don't count. Volunteering feels amazing, but your hours aren't deductible. However, the expenses related to volunteering can be gas mileage to the charity event, deductible. Supplies you bought for a community project, deductible. The IRS allows you to deduct 14 cents per mile for charitable driving. It might sound small, but if you're an active volunteer, those miles add up quickly. Number 4. Itemize or standard deduction. What's better? This part confuses a lot of people, so listen closely. You can only claim charity deductions if you itemize your tax return. That means listing out your expenses, like mortgage interest, medical costs, and charitable gifts, instead of taking the standard deduction. For 2025, the standard deduction is roughly $14,600 for single filers and $29,200 for married couples filing jointly. So, if your total itemized deductions, including your charitable donations, don't exceed that amount, it might not make sense to itemize. But here's a trick. Bunch your donations. If you donate every year, consider combining 2 or 3 years' worth of donations into one big year. That could push your deductions above the standard limit, allowing you to itemize and benefit more. It's a simple timing strategy, but it works. Number 5. Cash versus non-cash donations, the smart move. Charity isn't just about giving money. You can also donate clothes, furniture, electronics, or even cars. These are called non-cash donations. When donating goods, make sure to get a receipt that describes the items and their fair market value. For example, if you donate a used laptop worth $400 to a school, you can deduct $400 from your taxable income. And if your total non-cash donations exceed $500, you'll need to fill out IRS Form 8283 for donations worth more than $5,000. Like art or real estate, you'll need a professional appraisal. Here's something many people don't realize. Donating appreciated assets, like stocks, can give you a double benefit. You avoid paying capital gains tax, and you get to deduct the full market value of the stock. Let's say you bought stock for $1,000. and now it's worth $5,000. If you sell it, you owe taxes on the $4,000 gain. But if you donate the stock directly to a charity, you pay zero tax on that gain and still get a $5,000 deduction. That's what I call donating like a millionaire. Number 6. Keep proof or risk losing deductions. This one's simple but critical. If you can't prove your donation, the IRS won't count it. Period. Always keep a written record, like a bank statement, credit card slip, or official receipt from the charity. If you donate $250 or more, you must have a written acknowledgement from the charity that includes the date and amount. If you're donating non-cash items, take photos and keep valuation notes. Apps like It's Deductible from TurboTax can even help estimate fair values for used goods. Think of your proof as a tax insurance policy. You hope you won't need it, but it protects you when you do. Number 7. Use donor-advised funds, DAFs, to supercharge giving. If you want to take charitable giving to the next level, donor-advised funds are one of the most powerful tools out there. A DAF is like a charity investment account. You contribute money, get an immediate tax deduction, and then recommend grants to charities over time. Here's why it's genius. You can bunch your donations in one tax year to get a big deduction, say $10,000, but distribute the funds gradually in the future. For example, you might donate $10,000 to your DAF this year and support 5 different charities with $2,000 each year for the next 5 years. You've already locked in the deduction, but can give strategically over time. Plus, the funds inside a DAF can even grow tax-free if invested. It's like having your generosity compound interest. Number 8. Donating through payroll or workplace programs. Many employers offer payroll deduction plans for charity. You can set a fixed amount from each paycheck to go directly to approved nonprofits. It's automatic, easy to track, and some employers even match your contributions, doubling your impact and your deduction. If your employer offers donation matching, it's like finding free money for your favorite cause. Always check if your workplace has a charitable giving program before donating elsewhere. Number 9. Be strategic with timing. Taxes are all about timing, and charity is no different. You can only deduct donations made before December 31st of the tax year. So if you want to boost your deductions, make sure your donations are processed before midnight on New Year's Eve. Here's a pro tip. If you're planning to make a large donation, do it in a year when your income is high. The higher your tax bracket, the more valuable your deduction becomes. That same $3,000 donation saves more money when you're in a higher bracket. Charitable giving is emotional, but timing it strategically makes it financially smart too. Number 10. Watch out for deduction limits. There's one more thing most beginners overlook. The IRS limits how much you can deduct based on your income. For cash donations, you can usually deduct up to 60% of your adjusted gross income. For non-cash items or appreciated assets, it's typically 30%. Anything above that can be carried forward for up to 5 years. So don't worry if you give more than the limit in 1 year. You can still use the remaining deduction in the future. Number 11. Common mistakes that can cost you. Here's a quick reality check. Even the most generous givers lose money on taxes because of simple mistakes. They forget receipts. They donate to non-qualified groups. They overestimate the value of used items. Or they fail to itemize correctly. For instance, one couple in Texas lost over $10,000 in potential deductions because they didn't get written acknowledgement from the charities. They gave sincerely, but they missed the paperwork. So before you donate, think like a tax pro. It's not about being greedy. It's about being organized. Number 12. Give smart, not just big. At the end of the day, charitable giving is about heart, but maximizing your charity tax benefits means you're also using your head. By understanding how deductions work, timing your donations, using donor-advised funds, and keeping good records, you can multiply your impact while lowering your taxes. Think of it this way. If you save $2,000 on taxes through smart giving, that's $2,000 more you can donate next year. The more efficiently you give, the more good you can do. Number 13. Use qualified charitable distributions, QCDs, from your IRA. If you're 70 and a half or older, you can make charitable donations directly from your IRA using something called a qualified charitable distribution, or QCD. This allows you to give up to $100,000 per year directly to a qualified charity. Here's the best part. That donation counts toward your required minimum distribution but does not increase your taxable income. For example, if you need to withdraw $20,000 from your IRA but don't need the cash, you can donate that $20,000 as a QCD. You meet your distribution requirement, you support a cause you love, and you avoid the tax hit from the withdrawal. It's one of the most efficient ways retirees can give and save on taxes at the same time. Number 14. Donate through your estate plan. Charitable giving isn't just about helping during your lifetime. You can include charities in your will or trust so your legacy continues even after you're gone. By leaving a portion of your estate to a charity, your heirs could also benefit from reduced estate taxes. For example, if your estate is worth $2 million and you leave $200,000 to a registered nonprofit, that amount is deducted from your taxable estate. It's a powerful way to ensure your money supports causes that reflect your values long after you're gone. Number 15. Donate appreciated real estate or property. Many people don't realize they can donate property, like land, buildings, or vacation homes, to charities and unlock major tax savings. When you donate appreciated property, you avoid paying capital gains tax on the appreciation, just like donating stocks. Let's say you bought a small piece of land for $50,000, and now it's worth $150,000. If you sold it, you'd owe taxes on the $100,000 gain. But if you donate it directly to a charity, you get to deduct the full $150,000 and skip the capital gains tax entirely. That's a win for you and the organization receiving the gift. Number 16. Keep an annual giving plan. Charitable giving shouldn't be a random end-of-year scramble. Create an annual giving plan so you can maximize both your impact and your tax savings. Start by listing the causes you care about most, setting a yearly budget for donations, and deciding which type of gift, cash, stock, or property, makes the most sense for your situation. Tracking your giving also makes it easier when it's time to itemize your deductions at tax season. Plus, planning ahead allows you to take advantage of employer matches, DAFs, and timing strategies throughout the year instead of rushing in December. Number 17. Don't forget state tax benefits. Federal tax deductions often get all the attention, but many states also offer their own tax incentives for charitable giving. Depending on where you live, donations to certain types of organizations, like schools, food banks, or community programs, may qualify for state tax credits or deductions. For example, some states let you claim a dollar-for-dollar credit for specific local charities, which can be even more valuable than a deduction. So, before filing, check your state's Department of Revenue website to make sure you're not leaving any extra savings on the table. Number 18. Use charity credit cards or reward points. Some credit cards let you automatically donate cashback rewards or points to charity. It's not a tax deduction, but it's still a creative way to make an impact without spending extra money. However, if you use a credit card to make a donation, the deduction only applies to the amount charged, not to any reward points. Here's a quick example. If you donate $500 to a charity using your card, that's deductible. But if you donate 10,000 reward points, it's not. Still, it's a fun and simple way to give if you're looking to support causes passively throughout the year. Number 19. Don't overlook employer stock donations. If you work for a company that offers stock options or restricted stock units, you might be able to donate some of those shares directly to a charity. It's similar to donating regular stocks. You avoid capital gains taxes and get to deduct the full fair market value. This method is particularly useful if your employer's stock has appreciated significantly over time. Instead of cashing out and losing part of it to taxes, you can use those shares to do good and save money. Many corporate programs even streamline this process through their HR departments, so it's easier than most people think. Number 20. Track your giving digitally. Gone are the days of storing piles of paper receipts. There are now several apps and platforms, like Charity Navigator, GiveWell, and Daffy, that help you manage, track, and verify all your charitable donations in one place. They can generate year-end reports you can share with your tax preparer, making filing season smoother and ensuring no donation slips through the cracks. A little digital organization can mean hundreds or even thousands in saved deductions. Here's a question for you. If you could save hundreds of dollars in taxes just by planning your giving a little smarter, what cause would you support first?